Good morning. This is Tom Alexander. It is Sunday, June 11th. It is 8:20 a.m. Eastern Time in beautiful Charleston, South Carolina. This is the weekly report. This is the video addendum to a written report that all of you should have received. It is free. If you have not received it and you would like to begin receiving it, send me an email to tom@alexandertrading.com. I'll put you on the list and you will get the free report each week. Also, if you would like, subscribe, make comments to the channel. It is all very helpful and it is much appreciated. Okay, another week up. Now we have a big week news-wise coming next week. The big event of which is the Fed announcement meeting on Wednesday. Let's just dive into the charts now. There is much to discuss as usual. We're going to start with the weekly view. And here are the four primary U.S. trading indices: the cash markets, the SPX, Index, Dow, and RUT. And you can see where we are in terms of distance from all-time highs. Now, it may come as a surprise to find that to notice that the Dow was only 9%, and it actually led the charge off the October low. But the thing about the Dow, it made all its progress and stopped in December, and since then has not taken out that December high, where the SPX and the Index have certainly ramped higher. The Russell continues to lag, but it has shown strength the past couple of weeks, which is necessary for a new bull market. Now, you can see on the screen here, there is a huge difference still structurally among the indices. And this has been the thing that's been bugging me since the October low, is the disparity in the structural positions of the market. You can have bull markets and bear markets. In bull markets, you will have underperformance, outperformance by one index or another. Same thing in a bear market, you'll have one leading to the downside, but you don't have these persistent, incredibly disparate structural divergences that we have. And we still have them. You still have the SPX, and in particular the Index, trading higher. You have the Dow that cannot get above a very, very critical key reference area. You have the Russell that has broken to the upside from a multi-month balance area, but it is still below yet another critical level. Let's just take a look at each one individually from a daily perspective. Okay, here the daily. I'm going to start with the SPX. And you can see last week we traded into, and then Friday closed below or down on the day. We've traded into that area, that key reference area that includes this August high. It also includes a double top from way back in May. Above this level, there really isn't much. You're starting to guess a little bit because you're in an elevator shaft that extends all the way up to about 4,500. Okay, and the Index, of course. Now, the Index is very close to that equivalent 4,500 level in the SPX. Now, not that close, but pretty close. Let's just see how close since I brought it up. Not that far, 4.5%. And you can see here are the levels to the downside that need to hold under the immediate bullish scenario. I'll discuss that further in a minute. And of course, the Dow has all of this overhead key reference area, potential resistance to get into. And then, of course, the Russell that has everybody excited because it finally started to show some life last week. And it stopped on a diamond here above this level. Then again, it gets a little bit iffy where it might or might not stop. The critical level is still the way up here. That's a long way away. That's another 8-9%. So, but if we're in a bull market, eventually you'll see this. Let's look at now the technical situation. We'll start with VIX. VIX is the lowest it has been since way back here, and before the pandemic panic to the downside. But now that said, it can stay at these levels for a long time, as you can see. And in a bull trend, that's what you expect. You expect to see a low VIX. We have not been above 20 now in months. We've been at 20, but not really above 20. Now, looking at breadth, and this is interesting because what we have here, the red line you see is a 10-day moving average of NYSE advancing issues. The green is a 5-day moving average of advancing issues. And this peaked way back here last November. And since then, it has made a series of lower highs, and as I'm speaking, as we head into the Globex trade on Sunday evening and the cash trade on Monday, it's diverging again. Now, divergences can be resolved one of two ways. This can be resolved bearishly, where we're in the process of making some sort of significant top, or we just continue higher. We are not yet at an upper extreme in the 10-day moving average of breadth, and we could certainly get there. And even if we do get there, we'd still probably have further strength. I will point to this as an example. We reached an extreme here, went a lot higher. We reached an extreme here, went a lot higher before we finally topped out, reached an extreme here and went higher. So just because even if this were to reach an extreme, actually, if it were to reach an extreme, if it were to take out this 1815 level, that would be a bullish event. So, but I will say this, and this is where we need to go to a shorter term view. Okay, this is the SPX. This is intraday. Obviously, this is cash data, and you have breadth below it. Now, in a bull trend, if this is behaving textbook for a bull trend, we're making higher highs and higher lows. And anytime you reach down into these two zones, one or the other of these two zones, you get an immediate bottom and an immediate, this was sort of a consolidation, but it stopped on a dime, held. And now as we head into Monday, we're in here. So if the pattern continues, you're looking for higher prices. Now, what if it doesn't work that way? Because this is not paint by the numbers. Well, what you are looking for, what you really want to see now, you want to be paying attention to what happens when the market does reach down into this lower level, because then you should be under a bullish scenario near a short-term low. Likewise, if we are in a bull trends tend to, the ranges tend to contract, the volatility tends to contract, and it's more of a grind higher than the 1.5 up, 1.5 down, 2% up, 2.5% down stuff that you see in a bear market. Bull markets are mind-numbingly grinding and persistent to the upside with shallow retracements. You get gaps in the morning in the cash market, then you have this super narrow range all day, and it's very difficult for most traders, especially day traders, to make money because the intraday ranges are so small. And if we're in a bull trend, that's what you're going to see. Now, next week, I think there is something that comes out every single day on the news front that could be market moving. So it's going to be a good test of what we're seeing here in this trend. You guys enjoy the rest of your weekend. I hope you have found value. Again, if you would like to receive the report, you're not receiving it, shoot me an email, tom@alexandertrading.com. I will talk with you next week.